So next, let us understand audit evidence. What is audit evidence? Audit evidence is the information that is used by the auditor to arrive at his opinion. So as I said, the objective of the auditor is to give an opinion, and his opinion is framed based on the evidence he collects. So he needs to establish, the auditor needs to establish a process where he designs and performs certain audit procedures to identify, to collect the audit evidences, sufficient and appropriate audit evidences. Audit evidences, an auditor, in order to in order to form an opinion, the audit evidences have to be sufficient in nature as well as appropriate. Sufficient measures the quantity of the audit evidence, like how much evidence he has gathered. If the transaction he is trying to prove true and fair, if it is a risky transaction, then he has to collect more amount of evidence. Like more samples is required. More samples means more evidence, definitely. Second is appropriateness. Appropriate measures the quality of the evidence. If evidence is to have a good quality, it has to be relevant as well as it has to be reliable. Relevance means for what purpose he is collecting the evidence for. Like what is the characteristic he is trying to prove in terms of a transaction. If he is trying to prove that the revenue has occurred, then he needs to have an invoice in nature. But whereas he is trying to prove we have received the cash based on the revenue, he should have a bank statement in nature. So the audit evidence he is trying to prove should be connected with the logical purpose of the procedure that he is performing. So he's trying to prove, whether we have received the money in relation to the revenue, he has to go and check the bank statement. He cannot go and check the invoice and say whether we have received the money or not. So the purpose and what kind of characteristic the transaction is we are trying to prove is what is required. We'll study this later in chapter 7 and 8 in detail, but yeah. The second one is reliability. Reliability is based on the source of the audit evidence, the source and the circumstance under which we have obtained it. Reliability depends completely upon from where we have got the evidence, like who has given us the evidence and how did we collect the evidence and from which source we have received the evidence. An audit evidence is reliable firstly based on this chart that I have given to you. An external evidence are more reliable than an internal evidence. External evidence is coming from third party. Third party might not, lie. So an external evidence is more reliable than getting it from the client's internal records, because internal records can be manipulated by the management. If the auditor himself is going and collecting the evidence or directly taking the evidence, then definitely it is more reliable. Entity-driven evidence, if the entity himself is obtaining the evidence, then it is reliable only when the control are operating efficiently. The control are operating effectively, then entity-driven evidence is reliable. Of course, written evidences are more reliable than the oral representations, because oral representations can be retracted or modified as per the convenience of the management. So written evidences are more important than oral. Original, we need original documents rather than photocopies, because photocopies can be easily altered by the client. So definitely when you're collecting an evidence, it has to be from a reliable source, and the document themselves have to be a reliable document for us to prove a transaction. And when an auditor is trying to collect these evidences, he performs the so-called procedures that we have highlighted here. Auditor tries to collect the evidences in two nature. First, he tries to prove the control is working fine or working effectively. It's called as test of controls. He's collecting evidences about the operating effectiveness of the control, because the control prevents and detects material misstatements. So if the control prevents and detects material misstatement and the control is working fine, and if you're proving that the control is working fine, then there could be no material misstatements in the financial statement, right? So let's say, for example, in a store, there is CCTV camera and the CCTV camera is working fine, or there is a burglary alarm and that is working fine, and then there will be no criminals who will be trying to steal items from the store. Because if he tries to steal, he will get captured in the camera and the alarm also will start ringing, and hence we will be able to catch the thief. So similarly, controls are established to ensure that firstly, people who are trying to make a fraud or commit a fraud will be scared of it because he will get caught. Second, even if without his, without showing lack with having lack of knowledge, he goes and commits the crime, he will get detected. So test of controls are established in such a way to prevent or detect fraud or errors happening in a financial statement. And if we prove that the test of controls are effective, and in turn we are proving that financial statements are free from material misstatement. The second way we are trying to identify or gather the evidence is through substantive procedure. Substantive procedures are the audit procedures that is performed directly on transactions, on all the transactions, and to collect necessary audit evidences. The auditor will perform these procedures to collect the evidences. In short form, they are AEIOU. A stands for analytical procedure. Analytical procedure means analysis. For example, ratio analysis. Comparisons. Comparing the financial data with the financial data themselves, or comparing the financial and non-financial data. That's called as analytical procedures. When you perform analytical procedures, you will be able to get a preliminary identification whether there are any mistakes in the financial statements or not. Inquiry, you're talking to the client and understanding the process, how they have recorded the transaction. It is an evidence. Inspection, you're checking the books of accounts, you're checking the evidences themselves, you're checking the invoices, you're comparing against the transactions, is obtaining evidence themselves. Observation, you're checking how the accountant is performing the journal entries or posting the journal entries, is a collection of evidence themselves. Recalculation, the client has calculated some depreciation and we are trying to recalculate it, is a way where auditor is reperforming and checking whether they are appropriate. That itself is called as considered as obtaining a evidence. So that's called as substantive procedures. The substantive procedures we will perform based on the summary AEIOU. Remember this mnemonic, it's very important for your practical aspect, where when you're writing it, you need to think of how you're gonna perform each of the substantive procedure. Finally, once he has performed all this procedure and obtained all the evidences, it's important for him to come to a conclusion. And he'll come to a conclusion based on his opinion. The opinion of an auditor can be of two categories. One is modified opinion, and second is unmodified opinion. Unmodified opinion is the best opinion that the client can get, is true and fair, which means the financial statement gives true and fair view, or it presents fairly, means that the financial statement does not contain any errors. That is called as unmodified opinion. What about modified opinion? It does contain certain errors, or it's not correct. It's not true and fair. Modified opinion can be of two categories: due to lack of evidence, due to material misstatement. Lack of evidence means the client is not giving us evidence, or there is a transaction and we are unable to prove the transaction because we don't have any evidence. If we want to prove the transaction is true and fair, we need to have evidence. But if we don't have an evidence, then we cannot prove the transaction. And if there is a modified opinion and there is a lack of evidence, we will think of two categories. One is whether it is material but not pervasive. Second, material and pervasive. If it is material but not pervasive, we will issue qualified opinion, where we will say, except for this particular transaction or except for this particular account, everything is true and fair. So we are calling out only for one transaction or one specific account and saying that no, this particular item is not appropriate. Except this item, all other are true and fair. For that, if there is lack of evidence, we'll issue a qualified opinion where it's material but not pervasive. If it is material and pervasive, we will issue disclaimer of opinion. Disclaimer is close to saying that we have not given any kind of opinion at all. We are unable to express an opinion because everything is wrong. It's like I'm not able to come to a conclusion. Not able to come to a conclusion because I cannot say whether it is right or wrong because I don't have any evidence. So it is equal to saying the entire financial statement we have not audited at all. I have not formed any opinion at all. It's a very bad statement because they have not given us any evidence. And then the modified opinion can be given due to material misstatement. Material misstatement is where there is a transaction, but the transaction is erroneous in nature. Like it's not matching to the evidence that we have gathered. If the transaction or the account is material in nature, but they are not pervasive, we will issue a qualified opinion. Again, except for that particular account, everything else is appropriate. Everything else is appropriate. If it is material as well as pervasive, we will issue adverse opinion. We will say clearly that the FS do not present fairly. It's equal to saying everything is wrong in this transaction. Everything is wrong. It's equal to saying everything is wrong in this particular transaction because FS does not present fairly. Why? Because there is material and pervasive issue. So you can say the common words between lack of evidence and material misstatement of modified opinion is material and pervasive. What does material means? If there is a mistake or for a transaction we are unable to get an evidence, it is material if the transaction is above our materiality threshold. Then it's material. And what is pervasive? It's more than materiality. It's impacting a huge area of our profit or loss account. The transaction alone is 75% of our gross profit. It's a pervasive issue. It's a bigger issue. It's a bigger issue. Or it affects multiple areas. It affects multiple areas of the financial statement. It's a pervasive issue. Pervasiveness means it's a larger issue. It's a larger issue. Multiple accounts or multiple areas are wrong, or there are some problems with multiple areas or multiple accounts, then it becomes a pervasive issue. It's a much larger issue. Material itself means something wrong, but pervasive means it's exorbitant. It's very large. It's quite huge. For the time being, you can just understand this for the time being. So again, you can maybe pause the video and note down this particular process flow so that you can get an overview, because it's very important that you note this down because it's going to be tested in very recently in your chapters. Even from the first chapter you need to understand these particular jargons, and also as a AAA student you are expected to use the words qualified, disclaimer rather than saying modified or unmodified opinion, because modified and unmodified is a summarized way, but qualified, disclaimer, opinion within modification is very precise and to the point. So you need to know these topics as well. So take a note of it. You can pause the video and take a note of it.